There is serious talk about a potential 30 to 50% correction in the stocks and terribly brewing risks in the 1.7 trillion private credit market that I talked about in my last video that almost nobody is paying attention to. While everything on the surface looks bullish, the Fed is cutting rate coming this Wednesday, quantitative tightening ending being signaled by the Fed, trade deals being negotiated. But underneath, sophisticated investors are quietly preparing for something much darker. Today, we're going to break down some of these things because right now, the market is giving us conflicting signals that could determine whether we're entering euphoria or the beginning of a major turndown. And if you're asking yourself why I'm not putting up videos about new stocks, is because I can't consciously recommend anybody to buy stocks right now because I know I am not. Let's be clear about where we stand. On one hand, we have incredibly bullish catalysts ahead. The Federal Reserve is cutting rates this Wednesday, likely 25 basis points. They're expected to announce the end of quantitative tightening. We've got trade negotiations happening in China. A new Fed chair could be coming in May. Everything seems to be pointing continuous strength in the market. But here's what's happening that keeps me up at night. A private credit attorney just published an op-ed that reads like a warning from 2007. He's seeing lenders quietly rewriting their collateral rules, preparing not to prevent bankruptcies, but to be the first in line when companies inevitably go under. And this isn't just some random blogger. This is someone deep inside the credit markets watching sophisticated investors fortify their positions. And when smart money starts building bunkers, you need to pay attention. Let's start with what's happening in the private credit markets, because this is where the real danger lies. The private credit industry has exploded to over 1.7 trillion in size. That's as large as the entire leveraged loan market or high-yield bond market. And recent events have exposed serious cracks in the foundation. Refer to my previous video for more details. But here's the complete overview in as short time as possible. In September, 2 companies collapsed that should have been small. Isolated incidents: Tricolor Holdings and First Brand Groups. Tricolor was a subprime auto lender that allegedly double-pledged the same collateral to multiple lenders. About 40% of their loan portfolio showed identical attributes to other loans, meaning they were essentially committing fraud by getting multiple financings for the same asset. When the house of cards fell, it triggered a Chapter 7 liquidation. Then First Brands, the company behind Ephraim oil filters and Prestone antifreeze, just weeks before the bankruptcy. And this is crazy. Jefferies Bank was marketing this company as a $6 billion loan opportunity. The company supposedly had nearly $1 billion in cash. Weeks later, it imploded, revealing over $11 billion in liabilities and opaque off-balance sheet financing that nobody fully understood. Here's what makes this terrifying. These weren't just small private credit funds that got hurt. JP Chase took $170 million loss on Tricolor. Jefferies Bank got hammered on First Brands. UBS and Bank of America had exposure. Even Japanese banks lost billions. Jamie Dimon, CEO of JP Morgan, warned that when you see one cockroach, there are probably more. And we found them. Refer back to my last video. And he's right to be worried because that's what we're seeing right now in lenders across the industry. What they're doing is they're changing their loan covenants. They're adding what are called lien protections, basically legal language that says, if you go bankrupt, I want first dibs on your assets. This credit attorney noted that these lien protections are skyrocketing right now, just like they did in 2007 before the financial crisis in 2000. Let's take a quick look at this article that he posted called "A Private Credit Winter is Coming." Lenders quietly rewrite their collateral rules. And let's take a look at what he says. He says that the numbers at first glance look strong because deals value rose more than 200% in the third quarter. Yet beneath the surface, a quiet but dramatic shift is taking place inside credit deals that suggest creditors are bracing for distress, not recovery. Now, he also goes on talking about the 2 bankruptcies, and then he says, this is a symptom of a deep private credit system with potential unravel with the potential to unravel faster than anyone can track. Talks about the facts that First Brand collapsed on September 28th with more than 10 billion liabilities. Rainstone, which is a trade finance creditor, alleged that 2.3 billion in collateral effectively vanished. We covered that in our previous video. But in each of these cases, sophisticated creditors armed with advanced systems and compliance frameworks were blindsided by opaque privately structured financing arrangements. And the real story lies in that the private credit has grown so fast that verification and audit frameworks haven't kept up, leading to structural weakness across modern credit markets. Right now, the smart money is fortifying against a downturn because in the last quarter, something's changed. And he goes on to say, lenders shifted their focus from simply closing liabilities to securing high levels of lien subordination protection, the term that governs who gets paid first when everything falls apart. That's one of the sharpest quarterly increases ever recorded for a protective covenant, and it jumped by 23 points or percent in the third quarter, and now appears in the 84% of all credit deals, which means that going forward, not only are they not lending as much, but when they are lending, they're putting in these credit liens. The market signals is that lenders are no longer only trying to prevent borrowers from exploiting loopholes to stay out of bankruptcy. They are actively preparing for what happens when bankruptcy is inevitable. That's why lien protections are surging. The temptation in every credit cycle is to dismiss protective trends as overreaction. And it's showing us that these anxieties are spiking now. First, don't confuse deal volume with market health, because a rising issuance can mask deteriorating standards. But the same institutions driving new credit deals are often the ones quietly inserting stronger protections behind the scenes so that they don't spook the market. Third, he talks about treat term trends as early warning signals. Term level shifts in credit deals are a leading indicator of fear, often surfacing before defaults appear in public data. Wall Street public narrative is that the economy is resilient, inflation is cooling, and consumer credit remains stable. But when lenders are quietly rewriting the rules of engagement or demand all-for-one consent before lien subordination, it signals a system steeling itself for impact, meaning it's bunkering up. He goes on at the end, we may not see distress in early reports, but the foundations of credit protection are shifting fast. When that happens, it's never an accident. It's the market whispering what headlines haven't caught up to. The next phase of credit cycle has already begun. Okay? Because this is not just some random guy. And you won't be able to read this article unless you subscribe to the Wall Street Journal. So that's why I'm reading it to you. Let's move on. Now, let's talk about what's happening in the plumbing of the financial system, because this is where Jerome Powell and the Federal Reserve have a serious problem. The Secured Overnight Financing Rate, or SOFR, is the rate that banks, hedge funds, and financial institutions pay to borrow cash overnight. For normal people, this doesn't matter. But for massive institutions moving billions of dollars, even 5 basis points on $1 billion is a big deal. Recently, SOFR rates have been spiking above the Fed's target range, which is a warning sign that there isn't enough cash in the system. Banks have been borrowing billions from the Fed Emergency Backup Facility, the same facility that was created after 2019 when the Fed accidentally drained too much liquidity and caused overnight rates to explode. Here's what's happening. The Fed has been running a quantitative tightening for over 3 years, shrinking their balance sheet from about $9 trillion down to about $6.6 trillion. Bank reserves have fallen from over $4 trillion to just above $3 trillion. And Jerome Powell himself admitted on October 14th that the reserves have now fallen below ample level, meaning the Fed has gone too far with the tightening. A massive trade just hit the market, equivalent to holding $2 to $3 billion in 10-year treasuries, betting that the Fed will announce the end of quantitative tightening this Wednesday. This trade is positioned for SOFR to drop as funding pressures ease. Major banks like the Dutch Bank and Nomura see this as a conviction bet that the Fed will add liquidity back into the system. The New York Times published an article about these funding strains, noting that warning signs in crucial money markets have raised the prospect that the central bank will soon stop reducing its portfolio. When financing plumbing starts creaking, bad things can happen very, very quickly. Let's connect this to the real economy, because there's a wave of layoffs coming that could trigger exactly the kind of unemployment spike Jerome Powell is warning about. Amazon plans a 30,000 layoff from their corporate workforce, which is about 10%. This is also the largest layoff in Amazon history. Target also announced laying off 1,800 employees. We're seeing cuts across tech sectors and beyond. But here's what makes Powell nervous. The Beveridge curve, which is the measure between unemployment and job openings. Right now, we're in an unusual position. Job openings are really low, but the unemployment rate hasn't spiked yet. We're in what Powell calls a low hiring, low firing environment. And the curve tells us the curve tells us that we're positioned way off to the side, meaning that when layoffs do come, unemployment won't rise gradually, it'll skyrocket. Powell himself said on October 14th that the normalization of the Beveridge curve may have already begun. That's an eerie statement, almost identical to what the private credit attorney said about the credit cycle. Now, here's the game theory behind these layoffs and why they might accelerate. For a company like Amazon, with 10% profit margins, cutting $1 in salary is equivalent to getting about $10 in new revenue. So if Amazon cuts without affecting growth, they become more recession resilient and more competitive. Now, from a game theory standpoint, if company A cuts and company B doesn't, company A wins. So company B is also incentivized to cut too. So the question people ask is, what happens when companies fire everyone for AI and nobody has money to buy their product? Well, let's look at this rage against the machine chart that shows junior employees versus senior employees and talking about the AI pivot. And as you can see here, we're having a slowdown in junior employee roles as soon as ChatGPT was released and after that. And then on the side, we see senior employees after ChatGPT, and that's still on the rise. This means that a lot of entry job positions are going to be removed by AI. And it's literally the whole shtick of AI. And I don't know why people are so surprised by this. We created AI to improve efficiency. And in order to improve efficiency, that means that some jobs are going to be no longer required, period. Let's talk about margin debt danger. And this is where things get scary, because margin debt just hit 1.1 trillion for the first time in history. Investors are borrowing more money than ever to buy stocks. According to FINRA data, this is the highest level of margin debt we've ever seen. Even at the peak of 2021 bubble, if you download this spreadsheet and look at the previous, we were only at 900 billion. Markets historically top out when margin tops out. Now, that doesn't mean we're going to crash tomorrow. Remember, we still have those bullish catalysts we talked about, but margin debt creates a dangerous feedback loop. We've mentioned this before, and we'll talk about it again for those who haven't heard it. Here's how it works. When stock rises, investors borrow more to amplify gains. But when stocks fall, the value of the collateral behind those loans falls too. That triggers margin calls, forcing investors to sell their stocks, which drives prices lower, which triggers more margin calls. This positive feedback loop is why markets can fall so much faster than they rise. Some analysts argue that margin debt is just a coincident indicator. It rises when market rises, and that's particularly true. But when you combine record margin debt, private credit stress, SOFR dislocations, mass layoffs, and the Beveridge curve warning, you're looking at multiple warning signs flashing at the same time. Goldman Sachs President John Waldron just warned that if things go badly in private credit, and I quote, "defaults will not be good news. everyone in the financial system will feel the impact. And they stress that building up at the lower end of the economy where heavy borrowing has surged. And that is the real danger. This is a bottom-up problem, not a top-down issue. So what do you do with this information? Look, I'm not here to scare you or tell you to sell everything tomorrow, but I'm here to help you think strategically about risk management. If you have debt, specifically margin debt, credit card debt, personal loans above 7%, or high-rate mortgages, there's no harm in paying down a little bit. Make yourself resilient to a potential recession. The only harm is FOMO. But here's the truth. You never go bankrupt protecting yourself. But you can go bankrupt by not protecting yourself. Because it's all in the waiting. Sometimes the best move is to build a fortress balance sheet and wait. Can we get through this where everybody insulates themselves and the party keeps going? Absolutely. We've got Fed rates cut coming. We've got the end of quantitative tightening. We've got potential trade deals. The market just broke through resistance levels, and we could be entering a euphoric phase. But underneath the surface, smart money is preparing for winter. Lenders are rewriting covenants. Companies are laying off workers. The Fed is scrambling to add liquidity. Margin debt is at record highs. These are all early warning signs that people are putting blankets around themselves to save themselves from the winter. We're in late summer right now. Everyone's partying. But what happens when the cold front comes in and people didn't prepare? That's the question you need to answer for your own portfolio. When I heard about Tricolor and First Brands months ago, I said the biggest risk is that companies start taking a second look at their lending guidelines. That's exactly what's happening. Right now, all the big banks are double and triple checking their lending. So are we at a turning point? Well, the evidence suggests we might be. So stay vigilant. Manage your risk, and remember, it's not about timing the market perfectly. It's about surviving long enough to benefit when the opportunity presents itself. If you found this analysis valuable, smash the like button, subscribe to the channel, and hit the notification bell so you don't miss the next update. I'm going to be traveling for the next couple of days, so my posts will be limited. Drop a comment below and tell me what you think. Are we heading into euphoria or into a crash? And let's discuss it. Until next time, stay informed, stay protected, stay diversified, and I'll catch you in the next one.